Hi folks, Ryan Honeyman here from Lift Economy. Many folks have come to us over the last 10 years and asked, how do I get more involved in creating an economy that works for the benefit of all life? They also ask, what skills and experiences do I need to help make this transition? So 3 years ago, we created something called the Next Economy MBA to help address this and similar questions. Lift Economy's Next Economy MBA is an online course that's designed for entrepreneurs, aspiring entrepreneurs, students, recent graduates, employees, and folks who want to learn more about transformational next economy strategies and businesses. Join the growing alumni network of nearly 250 alumni who've gone through this program and learned essential skills and hopefully built lifelong relationships for catalyzing businesses in the emergent and regenerative economy. So we encourage you to check out our course. You can go to lifteconomy.com/MBA. The next course, Cohort 7, starts on September 21st, 2021. So once again, go to www.lifteconomy.com/MBA. And now, on with the show. Welcome to Next Economy Now. The goal of this podcast series is to highlight the leaders who are taking a regenerative, bioregional, equitable, democratic, racially just, and whole systems approach to creating the new economy. So welcome, Jenny.
Thank you.
So tell me a little bit about the mission you're on to help women raise the right type of capital.
Yeah, so I got really interested in capital raising about 10 years ago when I joined a small boutique law firm. I'm a lawyer, and I joined a small boutique law firm that focused on helping social enterprises in all of their legal needs. And of course, all businesses eventually, not all, but many businesses eventually want to raise capital. And what I learned was that a lot of businesses that I was working with that were very mission driven, wanted to do good for the world in addition to making money. The mainstream approaches to raising capital just were not a great fit for them. And I learned that a lot of the reason why they didn't know about other ways of raising money is that the world of lawyers that help businesses, a lot of lawyers don't know a lot of the different options that are available, and they kind of advise against more creative ways of raising money. So I spent the last 10 years or so really understanding what is possible under the law, because the law governing capital raising is somewhat complicated, and helping my clients raise money in much more creative ways than people often realize are possible. And they were able to do it in ways that allowed them to stay true to their mission over the long term and not be pressured to sell out their mission so that their investors could make huge returns. And so in that process, I raised money myself for my own business. And I did have a business partner, but I really was the leader of the efforts to raise money for the business. And I faced a lot of issues, fears that came up about approaching investors, feeling uncomfortable about asking people to invest in the business. And I started to really think about the unique issues that can come up for women entrepreneurs, especially mission-driven women entrepreneurs. And so I just got really, really passionate about helping more women entrepreneurs do what I did, which was to raise money for my business successfully. And, go through all those fears and doubts and get through the other side and make it happen. And interestingly, what I noticed was that a lot of my clients who I was helping to raise money were businesses led by men. And so I really started to make an effort to reach out to mission-driven businesses that were owned by women or, run by women to really help them be more successful in raising money. And what I found is that many of them weren't even thinking about raising money because they were so overwhelmed by the the thought of raising money that they didn't even consider it. So now what I'm really focusing on is helping mission-driven women entrepreneurs understand all the options for raising capital and then go out and implement so that they can raise money in a way that really fits with their goals and values.
Right. And so, the sort of hot topic or hot thing to do, it seems like, we're near Silicon Valley here in the San Francisco Bay Area, is, Y Combinator or some sort of traditional venture capital model. And so why or why not is this a good idea for the people that you work with?
Yeah, so that's one model that works well for some businesses. But if you really look at the statistics, it's probably less. Well, the statistics that I've read is that less than 1% of businesses get funded by angel investors or venture capitalists, and less than 0.1% get funded by venture capitalists. So that model, has its pros and cons, and I can talk about some of the good and the bad things about it. But what's even more important to know is that 99% of businesses, that model is not a good fit for them. That model tends to focus on high growth businesses, usually in the world of technology. And unfortunately, there is a lot of sexism and racism in that world. As much as that is starting to change, the evidence is that very few businesses that are run by women or people of color get funded in that model. So, it's I don't necessarily want to say it's a bad model, but I just think it's so important that people understand that there are alternatives, and there's very little talk. If Google how do I raise money for my startup, there's very little discussion about alternatives.
Right, right. And so, yeah, so what are you seeing? What are some of the alternatives that people have been finding success with?
Yeah, well, really, there's just so many different ways to raise money. I mean, really, it's an infinite universe if you start to think about all the different possibilities. One tool that I've used with a lot of my clients is something called the direct public offering. And that's a legal tool that, a lot of lawyers don't even know about, but it is actually possible to do some jump through some legal hoops that makes it possible to be able to publicly advertise your offering of an investment. And this could be any type of offering. You might be offering equity in your company, you might be doing a debt offering, you might be doing convertible debt. Whatever you want to offer, you can publicly advertise the offering, and you can set the minimum investment really low. So maybe like $1,000. I even had one client set it at $100.
Wow.
And actually, that's how I raised money twice for my own business. And it's a really great way of raising money because it spreads the risk among a larger number of smaller investors, and it greatly increases the pool of potential investors so that you end up having a lot more bargaining power. So my clients who have used that tool have been able to offer investment opportunities that were a lot more friendly in terms of what they had to give up. They did not have to give up voting rights. They did not have to give up, promise huge returns or be pressured to sell the company, kind of in the mainstream model that you mentioned earlier. The goal is usually to try to sell the company within 5 to 7 years and make a huge multiple on the original investment. Most investors are probably looking for a minimum of 10 times their original investment. And, again, that model can work for some businesses, but if you're not a high growth business, if you don't want to have to work 120 hours a week to be able to make your business grow that fast so it becomes an attractive target for being sold, you want to find investors that are happy with a more reasonable return. And so my clients have offered 3% annual return, 4% annual return, that sort of thing, where you're paying, whether it's equity or debt, you're paying something that you can manage and you don't have to be pressured to grow the company and sell it to be able to make your investors happy.
Right. And what's the amount of money that people can do in a direct public offering?
Well, there's really, there's a few different strategies for doing direct public offerings. If you're raising up to 1 million, it's usually a little bit easier from a regulatory perspective. But actually, there was just a new tool that just went into effect called Regulation A plus that actually allows you to raise up to 50 million from all 50 states. It doesn't require state by state filings, so that's another really exciting option that just became available. But it's, depending on your particular situation, the amount can be, a few 100,000 up to 50 million or even more if you want to do a little bit more in terms of legal compliance.
And it sounds it's always amazing to me how little people know about direct public offerings, and perhaps it's because of they're just not as sexy to the media or something. But you know, is maybe educating people a little bit. So, how is a direct public offering different than something like Kickstarter or Indiegogo?
Yeah, so the minute you're offering any kind of an investment opportunity, whether you're offering people the opportunity to buy promissory notes, which means lending you money, or if you're selling equity in your company, anything that you're offering that offers a return on investment, it becomes pretty highly regulated under state and federal securities law. So you cannot do those kinds of offerings on a Kickstarter or an Indiegogo or your typical crowdfunding website. All you can do on those sites is offer something where you're doing, you're offering some kind of a perk or a reward or a thank you. um, so the minute you're offering an investment opportunity of any kind, it does become more highly regulated. And that's why direct public offerings aren't super common, because you do have to jump through some hoops to be able to do it.
Right.
And right now, there's really not any platform out there. There's actually a couple platforms where you can advertise your offering under a direct public offering, but there's really no kind of crowdfunding platform where you can do them right now. That is about to change because another law just went into effect that is going to allow people to do what they call investment crowdfunding. And this is something that's brand new. You'll be able to raise money in all 50 states without doing state by state filing. You will have to do it through a platform, and there aren't any platforms available yet, but we should start to see some platforms becoming available very, very soon. It's not exactly clear when, because they're going through a regulatory process right now to get approved, but I'm guessing within a few months that will become available. So that's another tool in the toolbox. But, I do want to say that a lot of the clients I've been working with lately, they're choosing not to do a direct public offering because there are, some regulatory hoops that you have to jump through that takes some time and money to do. So even though I've had a lot of clients have success with that, I don't want anyone to think that that's the only option. A lot of my clients are choosing to do private offerings where they're not doing public advertising. So that means there's less of a regulatory hurdle that you have to go through to be able to do it. But they're just talking one-on-one with potential investors. And what I love for my clients to do is to just get really creative about who those people might be. One thing I like to say is that, some people, when you think of an investor, like I know one woman who helps people raise money, and she calls investors suits. So it's a common thing that when you think of an investor, you picture some professional investor who their full-time job is investing. They wear a suit. They have a lawyer on board, to make sure they screw you as much as possible.
Right.
But really, anyone can be an investor. So, you have to think really broadly about who your potential investors might be. It might be your customers, your suppliers, people through, where you worship, through your kids' school, etc. And, there's this idea that, oh, you shouldn't talk to those people. Some lawyers will tell you, oh, don't talk to those people, that creates a mess, But in my experience, it can be a really great way to raise money, and they tend to be a lot happier with a reasonable return and not expecting to have control. Whereas with when you do go to a more professional investor, like a wealthy angel, like if you go to a group called Investor Circle, maybe, or there's groups of angels out there, some focused on mission-driven businesses, some not. They do tend to be a lot more demanding in terms of what kind of return they're looking for, the way they want to come in. They're not necessarily going to be as flexible. Whereas when you talk to people who may not even be wealthy, they may have, $1,000, $5,000 that they're looking to invest. Even if it's tied up in their retirement account, they can invest it. And they might be a lot more open-minded when you say, you know what? I really don't have plans to sell the business, but I know that I can pay you an annual return of 3%. They might be really happy with that. And from what I've seen, that actually has been successful for a lot of my clients.
Right. So it's almost, it reminds me of like when you're saying suits, it reminds me more of like private equity or something. Whereas what you're sort of alluding to is the sort of flexibility that you might get with friends and family, but exponentially larger pool of friends and family or something. Is that kind of a decent analogy?
Yeah, I mean, you could call this a friends and family offer. I kind of don't like to use that term because I feel like sometimes it's kind of seen as like, oh, that's just a friends and family offer. That's not a serious capital raise, but it may be like, for example, when I raised money for my own business, we talked to people we knew. Actually, maybe my example isn't so great because we did do public advertising, but I have a client right now who's not doing public advertising, and they're talking to people they know, people in the community. The minimum investment is only $1,000, but a lot of people are coming in at more than that. They're raising their goal is to raise 500,000. And once they raise that money, they won't really need to raise any more money because that's really what they need to make their business viable. And so, it's fine to call that a friends and family offering, but what I call it is a successful capital raise,
Right.
because they've raised money from people who love them, who think they're great. They haven't given up any control. The cost of capital is very low because they're offering a very reasonable return. They're not making a promise like, oh yeah, we're going to sell our company to Kraft or whatever. It's a food company, but they could never sell it to Kraft because it's basically a produce. They deliver local produce. I don't know who they could sell it to, and that's not their plan. And by the way, they're a worker co-op.
Yeah.
So so they've designed an offering that totally fits with their goals as a business and what they know that they can reasonably offer to their potential investors. And they're raising the money. So it's a great way to raise money, and sometimes the term friends and family almost makes it sound like it kind of diminishes it a little bit. Like, oh, and people talk a lot about like, oh, you do friends and family when you first start out, but then you move on to the angels and the VCs. But, a lot of my clients, they never need to do another round.
Interesting.
They've raised enough where they're break even. The business is doing fine, and that's it. And if they do need to raise another round, they can always just go back to those same people.
Right. And so, sort of the devil's advocate position, you mentioned a 3% return. I think the historical average for the stock market is like 7 to 10%. So why would an angel or anyone want only a 3% return on their money?
Well, I don't know if your number is right. I've heard much lower numbers on average. I know this past year the stock market didn't, I think the net has been about zero.
That's true. My number was like the history of the entire stock market. So, like it's unlikely that someone would have invested in 1930 or whatever and ridden it till now. But you're right. I think the shorter, like more like in the 2000s, it's much lower than that.
Well, Michael Schumann wrote a book in which he said the historical returns were between 2 and 3%. And I don't know. I don't know what the right answer is, but I think that and then of course, if you put your money into a bank, it's, maybe 0.1%. And so a lot of people think, like, oh, like let's say I wanted to offer an investment opportunity and I was only going to pay 3% a year. I might think, oh my God, who would ever want that? Oh, I'm never going to get anyone to be interested, but I don't want to offer more because I know that's not reasonable because my business has a tight margin. And by the way, it's really important to me to pay living wages, so I can't afford to pay that much to my investors. Well, what I've found is actually there are a lot of investors who are excited by a 3% annual return because they're looking at more than just the return. They're looking at a lot of factors. They are concerned about the stock market because there's a lot of people are concerned that the stock market has some inherent instability in it and that it's going to be, having another big crash soon.
Yeah.
And there's, people who look at fossil fuels and how the stock market is valuing fossil fuels believe that those assets can never be valued the way that they're being reflected in stock prices right now. So there are a lot of people that are terrified of the stock market and they feel like it doesn't fit with their values. Over 50% of investors want to invest in things that fit with their values. So that's another thing. Then there are also people who love to invest in things where they know the person, where they've met the person before. They know their integrity. They're not just putting their money into some black hole where they have no idea, who these people are and what they're doing, what their ethics are. Then, there's other considerations too, like, oh, I really want to be able to go to a cocktail party and tell my friend that I invested in this cool startup in my community, or, oh, this investment opportunity involves not just a 3% annual return, but I also get a free beer at the brew pub every week, or, so there's just so many different things that people think about when they're making investment decisions, that even if the return might sound low, which by the way, if you compare it to the alternatives, I mean, even venture capitalists, if you look at their average returns, they're very low. Yes, there are a few huge home runs, but on average, the returns are not great. So believing that 3% is a below market return, I don't think is necessarily correct.
Mm. Yeah. And I think one thing that has at least driven me and other folks I know to invest or try to invest outside the stock market is usually with the publicly traded companies, you're just simply screening out bad, like alcohol, tobacco, firearms, gambling, nuclear energy, but you're not necessarily investing in what you would consider to be good companies. And so I think that this could offer a way for investor, the average person, to raise money and or invest in companies that they believe are actually doing good, rather than just not being bad.
Exactly. Yeah, and a lot of people want to diversify. They may say, well, I want to keep some of my money in the stock market, but I also want to put some of it into some other things as well. And of course, a lot of people, I think it's only about 50% of the people in the country that even have any money to invest. So, I definitely acknowledge that there's a lot of people that it would be difficult for them to invest in any small business, even if the minimum investment was $1,000. But that still leaves quite a lot of people, and you don't necessarily need that many.
Right.
Most of my clients are raising between a few $100,000 and maybe, up to 2 million or so. And a lot of my clients have actually had success offering. No, none of my clients have offered more than a 5% annual return.
Wow.
So it's very possible. And of course, the more people you can reach out to, the better chance that you will find those right people who totally love what you're doing and want to be a part of it.
And, what should someone, let's say, I'm a young entrepreneur looking to sort of start thinking about this, raising capital. What are some of the things that I should be thinking about as I'm sort of wading into this field? Like, what's kind of the process that you take people through?
Yeah, it's a great question. I mean, I think the very first thing is just to really understand that there's way more options available than what you might find by Googling around and also by talking to a more mainstream lawyer. So just first realizing that is a big step. And then the next step would be to just get really creative about who your potential investors could be. And what I recommend my clients do is start to make a list of some people that they may know who could be a potential investor or might know a potential investor and actually start talking to people and, don't necessarily offer an investment opportunity, but just do kind of an informational interview with them and just say, hey, I'm kind of thinking about raising money for my business. I'm really curious what you would think about the opportunity. Is it something you'd be interested in? Do you think you'd be more interested in this type of investment or that type of investment? What do you love about the things that you're investing in now and what do you not love? Kind of do market research because, you might find that there are people in your community that would absolutely love to invest in your business and just are waiting to be asked. And then, of course, designing your offering with a really open mind. A lot of people use a very cookie cutter approach to what they offer to investors. So, for example, a very common thing for startups to offer is convertible debt. And that's not necessarily a bad thing, but and of course,
what is convertible debt?
What is convertible debt? So convertible debt is basically your investors make you a loan with the expectation that in the future, when you raise a round of equity investment, their loans will convert into equity at a discount. So they get a reward for investing early. And that model works really well for kind of the Silicon Valley style model that we talked about earlier, where you're kind of expecting to grow the company really fast and then sell it. But for other types of investment, for other types of companies that have a different trajectory or, different values, it may not be the best option. And you can get really, really creative with what you offer. I mean, I've had clients offer some really creative types of investment opportunities, both equity and debt. Like I had one client who offered a type of preferred stock that looked a lot like debt, because it paid an annual dividend, a preset annual dividend, and then at the end of a certain period, the investor could ask for their money back, but they could only get back the same amount that they put in. So, that really took away the pressure to sell the company because all you could ever get back in terms of your original investment was the same amount you put in, but you would get a 3% annual dividend. And then I've had clients do interesting debt offerings where, they borrowed money from the investors and they calculated how much the investor got paid back based on the performance of the company. So the better the company did, the more interest the investor would get. So there's all kinds of really creative things you could do. And, the sky is the limit. So it's a great idea to design your investment offering to really fit your goals and plans and your values instead of just using some cookie cutter document that, your lawyer uses for every single one of their clients.
Right. So it sounds like what you're saying is there's a lot. I mean, you did say this. There's a lot. It sounds like there's a lot more flexibility than people realize. Even I'm just realizing that now. It's like you really can choose, what resonates most with you, or, just be more creative than just forming a Delaware C corporation and going to Silicon Valley and pitching people on Sand Hill Road.
Exactly. Yes. And I get really excited when I start to see my clients really see that for themselves. Like they get so empowered when all of a sudden they realize, oh, I can do this however the hell I want. And they start to see a lot of it is a mindset thing. I used to be so focused on the legal part. That was all I would ever talk about is, oh, you could do it under Rule 504 and you could do it under Rule 506C and you could use,
Yeah.
I was obsessed with that part. And of course, that part is important. But what I've learned recently is that equally important, if not more so, is the mindset, just realizing that, oh, what I'm offering to potential investors is actually really great. There's a lot of things that I have to offer. Maybe I'm only paying a 3% annual return, but you know what? I have really high integrity and they know that. I've demonstrated that. Or, my business is doing something in the world that a lot of people really care about and want to support. Or, I'm creating jobs in my community and there are people in this community that want to help me make that happen. There's just so many things that you can offer to potential investors beyond just a financial return. And if you start to see that as valuable, and see that what you're offering to the potential investors is at least as valuable as the money that you're asking them to give you, it just all of a sudden it just opens up so many opportunities and you start to feel like, oh, I have bargaining power. I can do this however I want to do it and what fits for my particular situation. So it's very exciting to see people start to realize that and think outside the box and design exactly the type of offering that fits for their situation.
Yeah, and you mentioned legal. Now, how often do you recommend that your entrepreneurs become a benefit corporation or a different type of legal form? How much does that play into the process that you go with?
Yeah, I mean, your legal form does definitely affect kind of what you can offer or the convenience of offering different things and the tax implications of different things. So just as one example, if you happen to be a limited liability company and you're taxed as a pass-through, you probably aren't going to want to have hundreds of equity investors because you could, and some people do, but it's a bit of a hassle because all of the profits and losses are allocated to all the individual equity investors. So you have to prepare these documents called K-1s, and it's a hassle. So, if you are an LLC and you're taxed that way, you probably won't want to do that. On the other hand, if you're a C Corp, then you may not want to offer equity that involves paying dividends because that isn't so great from a tax perspective because there's a double tax. So, the type of entity that you are does have an effect on what you can offer. But in terms of being a benefit corp, I feel that, if you're deciding whether to be a corp or an LLC and a pass-through or not a pass-through is one decision. But then deciding whether to be a B Corp or a benefit corp is sort of a separate decision because it's kind of a layer on top of those basic structural and tax decisions. And I would say it's almost always better to go ahead and be a benefit corp or a B Corp and or a flexible purpose or a social purpose corp or one of those many options because it does give you as the business owner the right to be more thoughtful about what you do with your company profits. If the whole point of those types of designations or entity types is that you have the right to consider multiple stakeholders when deciding what to do with company profits. And, especially in the case of if your shareholders said, you know what, we really want you to sell the company because we think we could make a bundle. Right. If you are a B Corp or a benefit corp or a social purpose corp or a public benefit corp, there's many different kinds. It explicitly states in your formation documents that you don't have to always put the investor's interest first in terms of them making the most profit. So why wouldn't you want that freedom, especially if you're a mission-driven business? So that part I almost feel like is a no-brainer. And if you're going to do it at all, you might as well do it early because the more you bring on equity investors, the more challenging it can be to convert to a benefit corp because your equity investors have the right to vote on the conversion, and they also have something called dissenters' rights, which means that if they don't want you to convert, they can demand that you buy them out.
Right.
So if you're even thinking about it, go ahead and do it now.
It's so much easier.
Yeah. And of course, if you are a mission-driven business, if you choose to be a benefit corp / B Corp, you're sending the message really loud and clear to potential investors that that's what you're about, and you're more likely to find investors that are aligned with your values.
Yeah. So maybe a few more questions here. I recently, it's somewhat talked about and or controversial, but I read Lean In by Sheryl Sandberg,
Mm-hmm.
COO of Facebook. And she was talking about encouraging women to sit at the table instead of, in a meeting, maybe sitting off to the side, and, actually, if they are going to get pregnant, not leaving or not like kind of letting their foot off the accelerator in what they're doing and sort of slowing down, to continue trying to get promotions up until they actually leave. I guess, my sort of one question I had is, is there any advice you would give to women about like talking to investors specifically, or sort of the approach, or, sort of any tips that you found that work well to actually, maybe making the pitch more effective, or any thoughts on that type of stuff?
Yeah, Lean In. I have to admit, I haven't read it. Um, but sorry, something went down funny in my throat. But when I think about the idea of Lean In, it makes me think of trying to change a little bit who you are to fit with a certain mainstream system and to have success within that system. So if you work at a big corporation, there you may need to change a little bit about yourself to have success within that system. And, I don't think that's necessarily a bad thing, but what I get a lot more excited about is saying, I'm going to be exactly who I am, and I'm not going to change who I am to fit within a certain larger system. And I'm going to just be so confident in what I am that I'm naturally going to attract like-minded people, including investors. So instead of trying to change who you are to attract investors, I think it's way better to be who you are fully and confidently, and just love who you are. And then naturally you will attract investors that totally, that get exactly what you're about and want to support that.
Right.
So, it's kind of a choice you have to make. I know a lot of women entrepreneurs who try to, who have tech businesses, who try to fit the model, the Silicon Valley investment model, and pitch VCs and try to figure out exactly how to pitch VCs in a way that's going to make them successful raising money that way. And unfortunately, the success rate is not good for women CEOs raising money from VCs. But there are women who are able to make the case and be successful in that arena. And that's okay. But I think, I just wonder, what did they have to give up, and what did they have to change about themselves that maybe they would have rather not have?
Right.
So, it's really a personal choice.
Awesome. No, that's great. So what are some of the resources? I know you have a webinar, it may be a series, and also an event coming up. And, just any sort of resources that women looking to raise capital could access to kind of learn more about this field.
Yeah, well, I have a blog where I write a lot about these issues, both kind of mindset issues and then more practical issues and legal issues. That's helpful. I also have a free ebook on my website about some of the basic things to think about when raising money. I do have a webinar coming up in mid-January that, let's see, what's the best way to find out about that? There should be a link on my website, jennykassan.com. And then I do have a live 3-day event coming up in early March, especially for women entrepreneurs who want to raise capital. And so we're going to be talking about all of the different tools and strategies to put together your capital raising plan, so that by the end of the 3 days, we will have talked about all these different pieces. So the mindset piece, how to deal with that, how to get more confident about what you're asking for, how to design your offer. Should it be equity? Should it be debt? What should be the characteristics of it? Who to talk to? Who are the best investors for your particular situation? how to approach them, what to present to them, how to get meetings with them. So all of that, answering legal questions, doing yoga, doing art projects. It's going to be really awesome. It's in Tiburon, California, just north of San Francisco. And yeah, so there's a lot of resources. You could probably access, all the information you need on my website, jennykassan.com.
And how do you spell Kassan, just for folks who may
Yeah,
not know?
so the full website is Jenny, JennyKassan.com.
Got it. Great, Jenny. Thanks so much. And we should have another interview sometime soon to kind of explore into these topics, because there's so much more we could talk about. But
exactly, would love to.
Okay. Great. Well, if anyone has questions, you can email Jenny at jennykassan.com. And our website for Lyft is Lyft Economy, LIFT economy.com. And thanks for listening.
Next Economy Now is a production of Lyft Economy. To listen to all of our episodes, go to lifteconomy.com/podcast. That's LIFT economy.com/podcast. You can also sign up for our monthly newsletter at lifteconomy.com/newsletter. Please also rate and review our podcast on iTunes, Spotify, Stitcher, or wherever you get your podcasts. Thanks for listening.